Happy Friday. Welcome to the Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. The economy posted a sharp rebound in the third quarter, exceeding expectations. Data from StatsCan indicates that gross domestic product rose 2.6% at an annual rate, driven by government spending and residential investment. Trade, however, was still weak. Imports dropped almost 9%, marking the largest decline since 2022. There was a decline in shipments of metals. That was a big part of it. Meanwhile, exports edged higher. In a flash estimate, StatsCan says the economy shrank in October by 0.3%. Alberta is lifting its 2025 growth forecast. The province now expects its GDP to rise by 2.1% this year, while growth in 2026 is expected to moderate to 1.8%. Alberta's budget update has signaled lower borrowing needs versus the first quarter. The province's deficit is expected to be $6.4 billion for the 2025-26 fiscal year. Culture Minister Stephen Guilbeault has resigned from cabinet over Prime Minister Mark Carney's energy deal with Alberta, specifically the pipeline memorandum of understanding. Guilbeault says Carney failed to consult Indigenous communities and that the pipeline would pose significant environmental risks. Guilbeault served as both Heritage and Environment Minister under former Prime Minister Justin Trudeau. He will stay on as an MP. It's likely to be a relatively quiet session in the United States today because of the Thanksgiving holiday. Futures south of the border, though, equity futures pointing higher. And let's have a look at the TSX, which has been hitting record highs this week. It edged up once again yesterday. And let's check out oil. Of course, one of the questions over these pipeline projects is, will oil prices recover over the long term? Will demand be enough to push oil up, given a strong supply around the world? Let's have a look at gold. Let's see how it's faring. There is a widespread expectation the Fed will cut next month. Lower rates seen as good for bullion. Let's check in on the loonie. There is also an expectation that Canada may hold off on an interest rate reduction in December, and that would tend to boost our currency. And finally, Bitcoin. Let's see how it's been faring. Way down from its record highs, but edging up about 1% today. Well, let's drill into that theme. The expectation that America will cut interest rates again next month, December 10th, while Canada will stand pat. We're joined by Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, great to see you. That's your thesis, that we'll get a cut in the US and Canada will stay on hold?
That's exactly it. But the thing with the cut in the U.S., our expectation is that that's it for a little while. The U.S. will go on pause. So it'll be interesting to see how the market reaction is following the Fed meeting. So basically how we're looking at the market right now, we expect risk assets, which are, corporate bonds, equities, to do well until the Fed meeting. And depending on how hawkish a cut it is, we could see volatility following that. But overall, we're supportive of we believe it'll be 2026 will be a constructive year for growth.
For both countries, so GDP growth?
Yeah, definitely for both countries. So you're kind of seeing the surprise today for both countries, but more so in the U.S. We do believe Canada will lag, but still continue to grow, have positive growth. The main reason for the lag is the uncertainty around CUSMA and the negotiations with the U.S. Because as long as we have that uncertainty, you're not going to get the very large private market investments in Canada. Obviously, we saw with today's number, the public markets or government spending is buoying growth. We expect that to be supportive, but you won't get the private non-residential growth until you have an agreement.
It sounds like our economy is just running on the same old moonshine, government spending and investing in residential, not the stuff we really need. Businesses investing in plant and technology.
There's one other moonshine that you forgot there, and that's the U.S. economy, which is significant. Even though we still have the tariffs and whatnot, our economy is still impacted at least 60% by what the U.S. economy does. That's why you're seeing it reflected in in exports. And that's because the U.S. will continue to do well. They have a lot of deregulation that takes effect in 2026. In addition, they're discussing the deregulation of banks, which allows them to have more capital or loan growth, which is supportive. So there's a lot, and there's tax cuts that take into effect in 2026 in the U.S. So all these things buoy very well for the U.S., well for Canada, but less well because of the uncertainty.
Let's have a look at the Canadian 10-year bond yield. Say, I know it's a ridiculously simplistic question for a guy like you. You're thinking yield curves off into the years ahead and mirrors within mirrors. But if you had a 5-year time horizon, would you be a buyer of Canadian 10 years at a yield of about 3.1% right now?
I'm going to answer it two parts. On a 5-year horizon, not necessarily, but we are buyers right now because on a 1-year horizon, we expect it to be within the range that you see. I think this is a great chart that you have on. We do expect the range for bonds to be exactly the same range as we had for 2025. So call it 360 to 275 on your page here. So we're mid-range, so we're all right buyers. But if we get up to the 365 level again, which we expect is a possibility in 2026, we will be very large buyers and go overweight bonds for that 5-year outlook. So timing is important. The yield is important because the yield you buy it at is the yield you will have until maturity. That is why at these levels, we prefer corporate bonds because you get your 320 that you see here on a 10-year bond, plus you'll get an additional, call it 125 to 150 basis points, depending on what type of bond you're buying for a corporate bond. So we are buyers of corporate bonds, not government bonds at this point in time.
I guess a couple of things could really hurt you if you hold 10-year bonds over the next few years. A ramp up in Canadian inflation. Is that a danger, do you think, Earl?
At this point, no. And the reason it's not a danger at this point, just think about it very simplistically. It's about supply and demand. So because of the uncertainty of the negotiations with U.S., there's less demand here in Canada. You know, you saw that in today's number again, less imports, less spending. So that means you have excess supply. When you get inflation is when you have excess demand. So we're a little ways until that. It's not a concern in Canada until we get an agreement with the U.S. Then you have to analyze the inflation outlook. But right now, no, inflation is not a concern.
And is there any risk of the bond vigilantes taking a run at Canada, given the threat to our economy from tariffs and also the low productivity growth?
I would say, and almost, I don't say definitely often, but I'd say definitely not.
Okay.
And here's the reasons why. When the bond vigilantes take a run at bond markets, they're not just looking at Canada, they're looking at global markets. And there's many other markets that are more at risk than Canada. I can name 3 right off the bat. 4, UK, we hear all the goings on with the budget. France, same thing, budget and political issues. Japan, getting more fiscal spending, and ultimately U.S. I think U.S. will have an inflationary problem before Canada does. So when the bond vigilantes are looking, they're not going to go to Canada as the first place to start selling bonds, which makes us feel very comfortable buying bonds in Canada, specifically corporate bonds.
You have an interesting idea on corporate for a corporate bond buy here, Earl Davis. It's Interpipeline, and they're part of the Brookfield family. So you can buy these bonds, and they mature quite a decent time, 2032. You're getting a yield of about 4.3%. And so for somebody tying up money in the bond part of their portfolio, going right through for the next 7 years, you think this looks like a decent bet?
Yeah, and let me just explain the chart that you have on the screen because it's not your typical yield chart. This is the spread chart. This is the spread that you're getting above government bonds, and I think that's important here. Actually, it might be the price chart, but nonetheless, it's very close to the spread you get above government bonds. It's about 125 basis points. So this is a price chart, which may be confusing for some. So you're getting roughly a 4.30 yield on a 7-year bond. Why we like it? We like the cash flow. When you buy bonds, it's different from equities. You're very concerned about getting your money back when that bond matures. And there's a few things we look at to get the money back. One is, most important one, cash flow of the company, and is it supportive and going in the right direction? This definitely is. The other one is you look at the sector, and people may say oil, look at the price and whatnot, but they have positive cash flow at these low oil prices, which makes us more constructive. We believe the range will hold, and if anything, we're at the bottom end of oil price range. So that's supportive, and that means you might get a price appreciation from upgrade in the spread. This is triple B, so investment grade. But we do like it very much, and we are constructive heading into 2026 of oil for two reasons. One is we believe we're the bottom of the market. The other one is the spread you're getting. The valuations on the companies are still low compared to other sectors, and that makes it an attractive area to get additional yield and feel comfortable with owning those bonds.
And just we're tight for time, but the yield, I mean, it's not a great credit rating. It's triple B low, I believe, at DBRS. So it's only one. It's only just one level above junk. But you think Brookfield, as a group, will do just about anything to stop that credit slipping into junk territory?
Yeah, well, I redefine that as high yield because there's different types of high yield. And this would be actually an upper level credit or a high yield. It's the lower high yield, your triple Cs and like that we refer to as junk bonds. This could fall into a double B as opposed to a triple B, which would still be, we'd be supportive of. We're actually buying double B oil sector bonds as well because the yield's attractive. So that's why we are very comfortable, but the trend is saying it should remain investment grade. If our forecast comes through in regard to 2026 and oil, it could even be upgraded. So we do like it for that reasons, but that's why we're active managers. We have credit analysts that are looking at these companies, looking at these bonds every day, talking to management. And that's the important part in bonds and active management for corporate bonds is what do you select? And that's where you get your additional yield and feel comfortable with it.
Thanks very much. Thanks very much, Earl. Really appreciate it. Earl Davis of BMO Global Asset Management. Lots more coming up. It is the most important shopping day of the year in the US, but also it's spread to Canada. We're going to hear about how Black Friday demand is shaping up. Let's have a look at the U.S. markets. Apparently, it is a myth that turkey contains significant amounts of that amino acid that make you sleepy, or no more than other meats. You can see it looks like we are going to get a positive open for markets south of the border. There was a glitch, though, of course, at the CME, a technical glitch on the calculation of the U.S. futures. Let's get to Black Friday shopping. Canadian participation in this, it's really just a promotion, has been increasing steadily over the years. 84% of Canadians now say Black Friday is their most important shopping day of the year. We're going to take you now to one of our nation's busiest shopping centres. CTV's Scott Hurst is standing by at the Toronto Eaton Centre. Scott, fill us in. What's the scene there?
Good morning, Andrew. Shoppers have been allowed inside the Eaton Centre for a little more than an hour now, and I would say it's steady, not crazy busy yet, but speaking with people down here and speaking with retail analysts over the past couple of days, getting ready for Black Friday and really the kickoff of what's being known as the holiday shopping season, you can expect malls throughout the country to get busier throughout the day. Of course, if you remember Black Friday 10, 15 years ago, there was this huge emphasis on door crashers. crashers, which meant people had to line up for hours ahead of time. There were people that would even show up to stores with little tents, chairs, so they could stay warm and sit down and not just have to stand there outside for several hours. That's not really the case anymore, because I'm sure you've seen on TV, on the radio, or just walking anywhere where there's retail stores, you've seen Black Friday promotions for days, if not weeks already. And so there isn't really the same focus on door crasher deals, but stores here in the Eaton Center and malls across the country are still really invested in the in-store shopping experience of Black Friday. And so it's not all gone online. However, you can still get the deals quite early, days, if not weeks ahead. And of course, there's also the Cyber Monday phenomenon as well. And so there is a shift in how consumers plan to take in the day. But there is still a huge emphasis on people coming down to malls and going into stores and having the in-store experience when it comes to Black Friday itself. Maybe not the single day phenomenon that it was 10, 15 years ago, but it's still hugely important for retailers, whether it's online or a day like today being in-store itself. And a lot of people still plan to take advantage of the in-store deals that we're seeing here at Eaton Center.
Yeah, I do remember that footage we used to see of people getting into fisticuffs and pushing each other. Yeah, that seems to be a thing of the past. Budgets are under stress this year. How are Canadians planning to spend this year?
Yeah, what we're hearing from retail analysts, and I can reference a survey from the Retail Council of Canada, is that Canadians are expecting to spend relatively what they have been over the past couple of years. But you mentioned affordability. All of our budgets are, of course, under a lot of strain. Affordability is a huge concern, and Canadians are also particularly attuned to price increases potentially related to the whole tariff battle with the Trump administration, with the United States, and what that means for their budgets. So even though a lot of Canadians are still planning to spend roughly the same, they're trying to make those dollars go further, and then that means looking at sales, shopping around for sales, whether it's online, going to several different websites, or here in malls and at different stores, trying to compare prices and wait for the sales, wait for the deals like Black Friday deals so that they can get the best bang for their buck. And a lot of people still plan to see if those sales will actually match up when they come in store, when they come to malls like Eaton Center. But there also is still a significant amount of Canadians who are interested in buying Canadian as much as possible. So if affordability is the main concern, there still is a significant amount of Canadians who are doing their best to keep their dollars north of the border, as we've seen a lot of Canadians continue on with this Buy Canadian push, Andy.
Yeah, it's funny. Maybe I'm not using Amazon right, but I find Amazon is an increasing pain in the neck. I go looking for something, and it shows me a bunch of junk products I have no interest in. But maybe I'm searching it wrong. I don't know. A bit of a techno-peasant. Thank you very much, Scott. Scott Hurst, our CTV News colleague. Up next, we are going to bring you the latest on Canada's plan to unlock the potential of Alberta's energy resources. Prime Minister and Alberta's Premier agreed on the outline agreement that's needed for a new pipeline to be built to the West Coast. For more on the conditions that need to be met, CTV's Michael Le Couture filed this report.
Danielle Smith's excitement could not be contained. Alberta isn't getting a bitumen pipeline yet, but it is one step closer.
This agreement includes a clear path to the construction of an over 1 million barrel per day Indigenous co-owned bitumen pipeline to Asian markets.
If everything goes smoothly, senior government officials say construction could start in 2029. But there's one important caveat.
If there's not a private sector proponent, there won't be a pipeline.
That's just one of the conditions as laid out in the agreement, as is Indigenous co-ownership and collaboration with BC to share the benefits. There has to be a new carbon pricing agreement, and the Pathways Carbon Capture project must move forward for the pipeline to do the same.
I don't know that the Prime Minister would have agreed to a new bitumen pipeline without Pathways, and we wouldn't have agreed to Pathways without a new bitumen pipeline.
The carbon storage program is key to Canada meeting its commitment of achieving net zero greenhouse gas emissions by 2050. The federal Conservatives are criticizing the process, saying the Prime Minister could push this ahead using existing legislation.
We even supported him, gives him the power to approve it. So we only need him to do one thing for this pipeline to happen. Get out of the way.
Now, Alberta has until July 1st to submit a pipeline project application to the new Major Projects Office. If all of the conditions are met, then the federal government will make an adjustment to the oil tanker ban on the coast of BC.
BC's Premier David Eby says talk of a new pipeline through the province is a needless distraction. And coastal First Nations are adamant it won't be built. CTV's Andrew Johnson has more in this report.
Flanked by his flag-waving caucus, BC Premier David Eby responded today to the pipeline deal he was left out of for a project he calls fictional.
No proponent, no route, no money, no First Nation support. We need to make sure that this project doesn't become an energy vampire.
Eby labels the deal a drain on federal resources, a distraction from real projects, and missing critical consultation.
The first step, in my opinion, that has to happen is that the Prime Minister needs to sit down with coastal First Nations.
Coastal First Nations are clear in their opposition to a project they say could destroy their way of life.
We'll do everything in our power to protect our coast from a real threat of an oil spill. There is no technology that can clean up an oil spill. We will never consent to allowing oil tankers in our coastal waters.
The reaction from Northwest BC, the region also already at the center of multiple LNG and mining projects, is, according to one mayor, mixed.
People definitely want to see growth. We want to see economic activity. We want to see the communities flourish. The one thing about a pipe is, and this project right now that has me a bit concerned is I see BC taking all the risk and Alberta getting all the reward. So how do we line those up?
Public opinion in BC, according to a recent survey, is tilted towards supporting a new pipeline, but First Nations may have the final say. And as we've seen before in this province, if they are unwilling to sign on, a new pipeline may never materialize. Andrew Johnson, CTV News, Vancouver.
Opening bells are up next. And there you have it, the opening bell action. Oh, that's appropriate. Shopify is ringing the opening bell to mark Black Friday. I imagine their servers will be busy today. American Express is doing the honors in New York. And in Toronto, it's Rocklink Investment Partners celebrating the launch of their Rocklink Principled Equity ETF. We'll have to take a look at that on the ETF report. It's time for the first 50. Thanks for tuning in to BNN Bloomberg. Happy Friday. Let's check in on the equity markets before we get going here. Up the TSX slipping in early trading. Our market did hit a record high yesterday. We're slightly off that mark right now, down only about 0.1%. And there is the S&P pushing higher, not far off its own record. So where is it? 6,823. And our record for the U.S. benchmark was 6,890. 6,890. And that was on October 28th. But the American Broad Index there, not far off a record high. Few energy-related stocks we're watching right now. Gibson Energy. Let's put up a one-week chart to see how that one has done. RBC suggesting that if this memorandum of understanding leads to more production of oil in Western Canada, it's good for the likes of Gibson. Of course, they're a major player in storing and transporting oil. Keyera, they're well known for processing natural gas in particular, a huge producer of condensate. So up this week, but not a massive move. And let's have a look at Pembina, a a player in mid-market energy processing and moving energy. So holding its own today, actually not doing much on the week. Also in focus, though, are these Alberta-focused electricity producers, because we've seen a suspension of the clean energy regulations. And Capital Power could be a beneficiary here if they get an easier regulatory regime. Also, TransAlta, another big provider of electricity in Alberta, that one had a decent week. Apparently, critics of this move are saying that it could spark a race to the bottom, because all the provinces will be looking for laxer regulations. And Ontario, and right on cue, Ontario Premier Doug Ford is suggesting that he wants similar treatment. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much indeed for joining us. Pretty incredible, this outage at the CME. How appropriate. Apparently the cooling was acting up at a data center.
That's right. The cooling was acting up at a data center, and as a result, trading in the futures market was largely suspended for hours and hours this morning, given really tough time for investors to have a look at what might be happening in the market. And so it's worth watching these stocks as we get into the trading day here. CME was the company that was affected by this data outage. It's a data outage at CyrusOne, which is a company that went private a few years ago. But it affected trading, and it's worth watching not only CME's stock, but let's look at the New York Stock Exchange owner, ICE, their stock, the CBOE Global Markets, as well as NASDAQ. It's worth watching all of these today as we are I guess the market is still a little bit jittery, looking to figure out whether or not there's going to be further disruptions or whether we are truly back on track here. But it was an hours-long disruption this morning, resolved sometime around 8:30, 8:40.
So interesting that we have this physical vulnerability at the data centers, just something, refrigeration equipment. You think, whoa, that's an Achilles heel, though, it seems.
It is. It's you kind of don't often think about the plumbing of the market until it throws something like this at you. But remarkable because it lasted so long. If you look at the the overnight plot of the futures exchange, you see kind of a regular trading up until about midnight, and then just complete darkness until for hours until well into this morning. Really remarkable. And as you said, these data centers really need to be cooled in order to, I suppose, keep working and keep people trading.
CNH Industrial is a stock that's on your radar. It's a maker of farm equipment.
That's right. This is a maker of farm equipment, and it's worth watching today. JP Morgan downgraded the stock from to underweight from neutral. This is largely on the back of what happened with Deere earlier this week. You and I spoke earlier this week about how Deere sees a softer year ahead for agricultural equipment sales. CNH Industrial sells the same types of equipment, large scale in agricultural equipment, and now JP Morgan sees a weaker outlook for them as a result of what Deere says it sees into 2026, cutting the price target slightly by about 6.5% on that CNH Industrial stock. And just it's worth remembering that Deere earlier this week said that it sees about 15 to 20% softer 2026. So yeah, really a rough time for these agricultural equipment makers. Deere is the big one, it's the bellwether. And as a result, some of the, still large but less large companies are kind of feeling the fallout from that.
Jeff, thanks very much. Before we go, we've got something here for the silver bugs. Maybe we could put up a 5-year chart for silver. Now, we're showing the most active future, but our Bloomberg partners are reporting that spot silver has hit a record high, surpassing its peak in October. This is spot silver now for immediate trading. Spot silver topping $54. You can see the futures are actually at a higher level there. So the spot price for silver up almost 90% this year. And silver, of course, a much smaller market than gold. And it's going to be interesting to watch some of those silver leveraged equities in trading today. coming up, the TSX has been hitting record highs. Can it stay at this level? Can it move out to new territory? We'll hear from Jamie Murray after the break. Our market hit a record high yesterday as measured by the TSX Composite Index. But our guest says when you look at technical factors affecting the S&P 500, the picture may not be so bright. Let's get more from Jamie Murray, president of the Murray Wealth Group. Jamie, great to talk to you, and thanks very much indeed. Start off with your outlook for the TSX, though. Do you think it will tend to move higher for the balance of the year?
Yeah, we definitely think the TSX will continue its march higher. I think seasonally, it's a great time of year. The Santa Claus rally comes 80% of the time. 24 of the last 30 Decembers have been positive. So we still think it's going to be a great outlook, especially with some of the trade negotiations and economic news coming out of the government, like we saw yesterday with the pipeline and sort of the Unleash Alberta movement that we have coming forward. We think that's going to be good for the economy, good for the market. And yeah, it's just these seasonally, this is a good time of year. And when we've had a great 11 months, that generally bodes well for the 12th month.
Now, I don't think you're bearish on the S&P 500, but tell us, is it a more nuanced picture there for the American market?
Yeah, I mean, I don't think, we're definitely not bearish. And we've had a huge year as well in the United States. But certainly it has been a little bit more resistant, it seems like, to break out past the previous highs. And we're seeing some of the leaders of the market like NVIDIA, Microsoft, two stocks that we own, just kind of struggle right now to push higher. And so we might see a little bit of churn down south, and particularly as some profit taking occurs, some window dressing occurs, and some market rotation. So just that market being so concentrated and a couple of the really dominant, the two largest index constituents making up about 15%, NVIDIA and Microsoft, struggling to move higher right now. We might see some outperformance in Canada for the next few months.
Yeah, I'm just looking. I mean, Advanced Micro is down about 15% in the past month. Alphabet, of course, is rocking and rolling, up more than 20% since late October. But I mean, one criticism, of course, of the AI spending boom is that they're installing all this equipment, but tech stuff wears out. It should be depreciated pretty quickly. Now, people may say that's just an accounting item, but I guess there is a real risk that they're spending tens of billions of dollars on equipment that could be obsolete before too long.
Yeah, so I think there's a bit of missing nuance between leading edge and front of the line technology and the useful life of technology. Certainly, when NVIDIA puts out a new GPU and they're now on an annual cadence, the leading technology model companies are going to move to those brand new chips. You get more power, more performance out of them. But that does mean that the old chips are still obsolete. There's still very high workloads running on those GPUs from even 2021. A great article I read was when Microsoft, who was the initial company that started to extend these useful lives on chips, which actually started before the GPU AI boom. It was in 2021, 2022. They were retiring chips that were 7, 8, 9 years old. And so that was, I think, the rationale to extend depreciation schedules from 4 years to 6 years. And just like a new car, it depreciates strongly as soon as you drive it off the lot. But just because it's a 2-year-old car and there's better models available doesn't mean that the 2-year-old car has no more value and it should be written off.
You have some ideas for us here. Doman Building Materials, DBM, they're huge in pressure-treated lumber. Why do you like this name, Jamie?
Yeah, and so going back to the top, we're saying maybe Canada's going to outperform. A few Canadian ideas that we think can do well, and starting with Doman. So we saw the forestry sector have a strong move up. Doman has been a leader in the forestry sector, but they're not taking the lumber price risk that the the forestry companies that we traditionally hear about do. They're buying that lumber from those companies, treating it, and then it's also about the distribution and inventory management for large retailers. And so it's a lot more, it's a relatively stable business in the forestry sector. It's more of a volume game and a price spread game. So when we're talking about midstream oil companies at the top, Doman's more akin to those companies versus an oil company. So it's a great model. They've done a great job consolidating Canada and now the United States. They're a top 3-4 player in North America. And that scale brings additional competitive advantages like better purchasing power, better logistics. And I think the free cash flow yield on this stock is about 14%. So you get a 6% dividend. There's still lots of cash left over after paying that dividend to grow the company and make further acquisitions.
Linamar, globally big in agricultural equipment. Apparently that market not doing very well, broadly speaking, but also, of course, autos. Yeah, and so Linamar, we're seeing the stock, I think it's just actually below its all-time high, around $83, $84. It's hit that a couple of times over the last decade. We're seeing a bump up against that, and this is a stock that, if you look back over the really long term, it tends to have these big moves like 200-300% higher, and then it'll consolidate for almost a decade. And it's been a decade that Linamar has been trading between that $50 to $80 range. The multiples come way down. We're seeing the auto sector, not that the end market has improved, but Linamar's auto business is doing really well. Margins are moving higher. They're acquiring underperforming competitors. And that's going to drive earnings per share higher. And like you said, they do have an agriculture and industrial business. That business is depressed right now. It's going to take a year or two for that to recover. But we think when you start to look out to the end of 2026 and into 2027, you're going to have all three of its businesses moving the right direction. You can see earnings per share growth in those cyclical upswings of, call it 10, 15, 20% per year. And so, I think Linamar is just still at the start of a long-term move higher. And then finally, Northwest Healthcare Properties, a real estate play, doctors' offices and stuff. Yeah, so they own the medical office buildings. They own some hospitals as well. So it's a real estate play on medical properties. I mean, I've been on the show and we've written about it on our website. It's had a long history. It had a poor performance in 2021, 2022. That's the past. There's a new management team in. They're doing all the right things. They're selling off assets. The debt, which was an issue 2 years ago, is now under control. They're finding ways to optimize the business. The net asset value of this company is probably around $8 per share, and it's trading at $5.40. A very stable business. I think in Canada, the market loves the apartment REITs, and those you get a 3-4% dividend yield on. But in Canada, we're seeing pressure on home prices, pressure on rents, a huge amount of rental supply coming in. And so, if you're owning a Canadian apartment type company, I'd much rather own Northwest, where you get that economic, not sensitive to economic activity, a nice dividend that's growing, and a market that should have a really good next decade. Jamie, thank you very much indeed. Yeah, thanks for having me. Jamie Murray, president of the Murray Wealth Group. Yesterday on Market Call, we were joined by Mike Philbrick of Resolve Asset Management. The topic, exchange-traded funds. His top picks were BMO Equal Weight US Healthcare, ZUH, iShares Core Canadian Government Bond Index, XGB, and the SPDR S&P Biotech ETF, XBI. Today on the show, it's Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. The topic, Canadian and US large caps. When we come back, we'll tell you about 9 stocks that the world's top investors are backing right now. We've seen some of those big AI names wobbling. They're down from their highs. It could be good now to check out some of the stocks that the world's top investment professionals have been buying. and they're buying right now. We're joined by John Ehrlichman, a BNN Bloomberg contributor and the host of Ticker Take on YouTube. John, thanks very much indeed. Just remind us, what is this group of stocks?
So this is something that is compiled by Brendan Wood International, and we can explain a little bit about what they're all about. But essentially, they've identified, give or take, 25 stocks out of a global basket of about 1,400 companies, Andy, that they have found a deep level of conviction amongst some of the world's top investors. So how does Brendan Wood get to this? And I was thinking a lot about this just because you keep hearing this question about whether we've hit the top of the market. The headlines are starting to worry some people. So I think it does open the question of what are actually the smart money investors doing? Are they truly selling? And so Brendan Wood, every year, they talk to upwards of 2,000 professionals around the world. They have this system, they call it the Top Gun system. And basically, they're looking for top investors by scouring the world for who's been doing well, but then they're looking for the Top Gun investments that are held by these investors. And so we've got this piece on the website where we basically netted out of what they have found. And let's use tech as just one example, Andy. So, names like NVIDIA, people are like, okay, are people ready to throw in the towel on NVIDIA? Or other chip names like Taiwan Semi. Or what about, Microsoft's had this huge resurgence. Is it over? Well, the thing that they found, Brendan Wood, is that on average, when they talk to these 2,000 professionals, that for the most part, they are very much committed to stocks like that for at least the next year. And I thought that was interesting just because the headlines are creating some unease, but then you've got these smart investors who aren't selling.
That's interesting. Yeah, of course, they do take a long-term view. So it's not... It's interesting. RBC, JP Morgan, arguably the premier bank stocks in each nation.
Yeah, and look, this is not just a tech story.
Yeah.
Obviously, for investors to get return, they've been leaning into growth. But I do think what you find, or Brendan Wood finds, when they start talking to people around the world, is they're looking for reliable. They're looking for reliable management. They're looking for reliable balance sheets and still an ability to grow. So it was interesting, not only that JP Morgan's on there, that's obviously a bank under Jamie Dimon that gets a lot of street love, but the fact that RBC on a list that's quite global ranks so well. And I think that's because as a bank, they've just got a pretty good track record when it comes to winning over investors. And you can see from that stock chart, like it's been trading basically around all-time highs heading into earnings season.
And there was a name there called Welltower. John, can you tell us anything about that?
Long story short, Welltower is leaning into the aging population trend. So here's a company that is looking at retirement facilities around the world. They've actually done some big deals here in Canada as well. And we do have a number of BNN Bloomberg guests who often talk about the realities of financing an aging population. And so Welltower has really benefited from that. And, I think, again, when they look at it, they've got this whole list of things, Brendan Wood, that is, that they look at, including management and growth. But I think thematically, a lot of these global investors are trying to figure out what are the themes to watch over the next decade, which also helps to explain, like, if people are believers in AI or an aging population, it's not maybe a surprise to see, these kinds of stocks on a top 9 or 10 list around the world.
Here's a headline, just speaking of an aging population, a headline on MarketWatch. America is aging into a caregiving desert. Nobody is ready. And they're arguing that America needs to reform the system to avoid putting impossible pressure on adult kids of older people.
Obviously, this is a huge issue that we're watching. Ironically, we keep talking about these robots taking over. I don't know if they're going to help fill the gap as well. But you're right. I mean, this is obviously, it's great that we're living longer lives, but to ensure quality of care in your older years, that is something a recipe we're still working out, quite frankly, around the world and certainly here in Canada, too.
John, thank you very much indeed.
Thanks,
Always
Andy.
great to hear from you. That is BNN Bloomberg contributor John Ehrlichman. Up next, we'll check out some early market movers on the TSX. Let's have a look at some stocks. Well, first the TSX Composite, and then we'll check out some movers here. We mentioned earlier that, there's the TSX. Get out the champagne and the dancing dogs in little frocks. We are at a new record for the TSX Composite, pushing higher. And here's one of the reasons. The silver stocks surging. We mentioned earlier that the silver spot price hit a record high north of $54. And it looks like investors are buying pretty well anything with silver in its name right now. First Majestic Silver jumping. There's Discovery Silver higher. Pan American Silver is higher. Now, not all of these silver companies have the bulk of their output in silver. A lot of them just produce tons of gold, but silver comes along for the ride. Wheaton Precious Metals as well. That one moving higher. So investors excited about this rally in silver to new record highs. Up next, we're going to get some stock picks from our guests that they say are high conviction ideas. Welcome back. Let's take a look at some of the stories we are bringing you from the BNN Bloomberg newsroom. The economy saw a sharp rebound in the third quarter, exceeding expectations. Data from StatsCan indicates that GDP rose 2.6% at an annual rate, driven by government spending and residential investment. Trade, however, still shows signs of weakness. Imports were down almost 9%, marking the largest decline since 2022. They were dragged lower by a decline in shipments of metals. Meanwhile, exports edged higher. In a flash estimate, StatsCan says the economy shrank by 0.3% in October. Our own Lindsay Biscaya will be up shortly with more insight into the data. The Culture Minister, Stephen Guilbeault, has resigned from Cabinet over Prime Minister Mark Carney's energy deal with Alberta, specifically that pipeline memorandum of understanding with Alberta. Guilbeault says the Prime Minister failed to consult Indigenous communities and that the pipeline would pose significant environmental risks. He has served in the past as both Heritage and Environment Minister. That was under the former Prime Minister Justin Trudeau, and he will remain an MP. The Chicago Mercantile Exchange says all group markets are open and trading after an outage earlier that crippled key parts of financial markets. The exchange operator says the problem was caused by a cooling system malfunction at a data center in Chicago. CME offers futures and options across commodities, interest rates, equity indexes, foreign exchange, and crypto. The TSX pushing further into a record territory, boosted, as we just noticed, by precious metal stocks, spot silver hitting a record high today. And let's have a look at the U.S. markets. It's a quiet day because of the Thanksgiving holiday yesterday. Big traders right now, NVIDIA as usual, its stock slipping slightly down about 1%. Tesla's up about 0.5%. Not seeing any huge moves among the tech giants. Micron Technology advancing about 3%. Let's have a look at oil now as the world wonders if a peace deal is coming in Ukraine, which could free up more Russian oil onto global markets. Bloomberg says that oil is set for a fourth monthly decline on this outlook, predictions of a glut in the global market. Let's have a look at gold now. Earl Davis, BMO, told us earlier he does reckon the Fed will cut again on December 10th and lower rates seen as good for bullion. And of course, gold's little sister, silver, hitting that record high in spot price terms. And finally, let's have a look at the Canadian dollar. If we don't cut, but the Americans do, it is bullish in theory for our currency. Next week, we get earnings reports from the big Canadian banks. Royal Bank is due on Wednesday, and that is one of our guests' high conviction stocks. Let's get more from Shiraz Ahmed, CEO at Sartorial Wealth. Great to see you.
Thank you for having me back.
Now, just remind us, you're a quant, so momentum is a crucial criterion for you.
Absolutely. So in our Sartorial Opportunities model, we follow a momentum-based strategy where we use a lot of math ultimately to help determine, is a security having positive momentum at any given point in time? If it does, then we participate. It's a way for us to have more dispassionate decision-making.
But you don't just jump on a stock even because it's going up. You're interested in risk as well?
Absolutely. So the primary factor that we're solving for is risk-adjusted return. So we want to see how is it doing relative to its overall volatility. And it's extremely important, even if it's trending upwards, but if it's increasing its risk while it's doing that, that may not be a name that we want to hold for at least the long term. And
risk means volatility?
Primarily. So we look at standard deviation and then ultimately compute it into the Sharpe ratio and to see, is it worth its weight, frankly.
And the Sharpe ratio technically measures risk-adjusted returns.
That's correct.
Royal Bank is showing up on your screen. Tell us what's jumping out for you here. That stock's been hitting record highs.
Absolutely. Well, other than the obvious being the largest bank in Canada, it's a name that's been performing quite well. The banks have been on a tear in recent months. So it's a name that we like. I appreciate that earnings are coming up next week. While that's not necessarily a factor that we look at very closely, at the moment, the momentum has been very, very positive for it. I think on the back of the HSBC acquisition, it's been performing well.
Let's have a look maybe at a 10-year chart for Royal Bank because it has been hitting record highs, slipping slightly today, but up well over 20% in the past year, excluding dividends.
Absolutely. So again, it's been a solid performer and a great name, and it's a household name in Canada. And even internationally, one of your earlier guests was talking about the top 9 picks, so it is up there. So it's a name that we have a high conviction on. So long as the momentum stays positive on it, it's a name that we're happy to hold.
Franco-Nevada, FNV, shows up well as a precious metals idea.
Absolutely. Now, in recent months, given the gold's volatility, we have decreased our weighting in it slightly, but it is still a name that we like and has scored well. The momentum in the gold space overall has been positive. That's one of our favorite ways to play gold.
It's actually down from its record high, but a lot of the gold names are because gold is not quite at record highs. Do you ever buy individual gold producers, or are they just too volatile?
The volatility on them is just a little bit higher. So we find Franco-Nevada is a little bit more stable, especially with the company having as much capital as it does at its disposal. It's gold with a dividend, frankly, and we like it.
Here's an interesting name, Alibaba.
Yes. So Alibaba is a name that was recently introduced into our international side of our holdings. And again, it's a large Chinese consumer company. They have a lot of different opportunities within them. And it's another way for us to play AI in China, frankly. And it's a name that we've liked.
It's interesting. I mean, it is off its highs, but you do see decent momentum for this name.
The momentum is starting to pick up. Again, it's still a fairly low weighting in our model overall, but it is starting to pick up and is a name that we do like.
Right. There was a story yesterday suggesting that the U.S. military is wary of Alibaba over its connections to the Chinese military. But of course, your model, that's not a thing that enters into this model anyway.
Not specifically. Yeah. Again, we're aware of it. It goes into some of the fundamental analysis that we do for names that are going into the model. But overall, again, the rhetoric on sort of Chinese political intervention is there for a lot of Chinese securities overall.
Oh, for sure.
So how much of it is truth versus speculation is hard to determine. So for our purposes, we tend to look at price momentum as our main variable.
Yeah, and the stock is up about 86% this year. And then finally, GSK, a huge name in healthcare.
Yeah, so again, another one that has scored quite well. It's been a pretty substantial holding. Now, there's a little bit of R&D risk with any of the pharma names, so we're trying to keep that into check while we have it in our overall portfolio. But so far, it has, number one, helped with international exposure, but more importantly, it has been a fairly solid performer over the last little while.
Yeah, you can see up about 30, wow, almost 40% in the past year. Not sure if we could pop up a 5-year chart for that one. I'm not actually clear on whether it's hitting record highs, but certainly moving up sharply in the past year. Yeah, that's interesting because these healthcare stocks sometimes, or these pharma stocks, it feels a bit like showbiz. If you have a hot product, a hot movie, or a hot pill, investors love to get into the shares.
Absolutely. So they do. And it's also a lot of news-based as well, like there is with most securities. But, you know, for example, the recent lawsuit that they've had, it's been favorable on GSK's side. So, again, that's been positive for the stock overall. And there have been some share buybacks and whatnot over the last little bit, which, again, have been positive for the stock.
Shiraz, thank you very much indeed.
My pleasure. Thanks for having me.
Shiraz Ahmed, CEO at Sartorial Wealth. Coming up, more on that rebound in Canada's economy in the third quarter, albeit it was driven by government spending and residential investment. We'll be right back. It was good news, at least in terms of the headline read, the Canadian economy bouncing back in the third quarter, suggesting, among other things, that initial damage from the trade war may have worn off. Let's get more from BNN Bloomberg's Lindsay Biscaya.
And that's just it. I mean, a lot of economists are saying this looks good on paper, but when you look into what's moving the numbers, there is still some cause for concern. And a lot are saying, don't get too excited by this, but we'll go through those numbers to start. Third quarter GDP grew at an annualized rate of 2.6%. This blew past expectations. Many economists surveyed by Bloomberg were expecting an increase of 0.5%. So we're seeing 2.6 instead. It's the fastest pace of growth that we've seen since the end of last year. It obviously offsets the decline of 1.6% that we saw in the second quarter. But when we look at where that growth is coming from, it was driven by investments in housing, government spending, as well as crude oil exports. And some say this is kind of a shift away from that initial damage done by the trade war that we saw initially, but there is some pushback on that as well. A lot of economists say that this growth only looks good on paper, as I mentioned. And we spoke with Jimmy Jean, chief economist and strategist at Desjardins, and he said this mirrors what we saw in the second quarter because back then we saw a collapse in exports, and now we're seeing a collapse on imports. Here's more from him.
It's not a story about exports recovering. It's really about imports collapsing. And that mechanically produces that strong increase in GDP. But when you look at domestic demand, which had been the very positive story in Q2, we're seeing a decline of 0.1%, and you're seeing cutbacks in consumer spending in particular. So I think that's cause for concern here.
Yeah, and so Jean says this comes to domestic demand. Not all hope is lost, but we're definitely seeing people, not spending as much, being a little bit more prudent with their spending. And this is also in line with the Canadian Chamber of Commerce, who released a statement saying we need strong domestic demand to carry us through, and we just simply didn't see that in this quarter. And then just lastly, I just want to say that Stats Canada also says that the third quarter number could be subjected to a larger revision than usual, and that's because we're looking at numbers that rely on foreign merchandise trade data, and a lot of that data was not available because of obviously the U.S. government shutdown.
Oh, that's interesting. Yeah.
Yeah.
And we got some even more recent numbers for September or October.
Yes, for the month of September. So month over month, we saw a real GDP rate of 0.2%, right in line with what economists were expecting. Year over year, it was 1 percentage point. So that's compared to 0.6% predicted by economists. So that's for the month of September. An advanced estimate, though, for the month of October shows GDP might actually decline by 0.3%. And that is, of course, signaling a bit of a weaker start for the fourth quarter of this year. And then, of course, as we know, this comes ahead of the Bank of Canada's next rate decision next month. That's on December 10th, which is, believe it or not, a week and a half away. But a lot of economists saying these numbers we're seeing today probably won't move the needle too much in terms of a decision there.
Lindsay, thank you very much indeed. Thank you. Lindsay Biscaya. Coming up, we're going to check out some of today's notable analyst calls, including a price target boost for the cheesemaker, Saputo. Check out a couple of notable analyst calls and recommendations this morning. Saputo's price target raised to 49 bucks Canadian from 44 at TD Securities. This, of course, an international cheese and dairy giant. TD sticking with the buy rating on the stock, arguing that it's a best idea for 2026, and that despite a superior profit outlook, Saputo trades at, quote, a meaningful discount to many of its peers. Our second notable call, also from TD, is for EQB, the lender, the non-bank lender. TD Securities cutting the price target on EQB to 96 bucks from $105. You can see that stock's been suffering lately and staying at a hold rating on the shares ahead of the company's fiscal Q4 report. TD citing a more conservative loan growth outlook and persistent credit provisions for that cut in the target price. And our third notable call is on Canada's telecom sector. Morningstar says that the Canadian telecommunications companies are well placed to build out the artificial intelligence ecosystem. Morningstar DBRS's analyst Scott Ratty says this is because large national telecoms have the built-in, quote, technical expertise, resources, and reputation as trusted partners for mission-critical applications. Ratty adds that though we're still in the early stages of implementation, the telecoms that can move quickly on development and application of AI will be best positioned to capture business from companies and governments. So the Prime Minister and the Alberta Premier signed that memorandum of understanding. It is seen as a major new energy cooperation deal. Let's get more, though, on the conditions that need to be met for a new oil pipeline to the Pacific. CTV's Mike LeCouture filed this report.
Danielle Smith's excitement could not be contained. Alberta isn't getting a bitumen pipeline yet, but it is one step closer.
This agreement includes a clear path to the construction of an over 1 million barrel per day Indigenous co-owned bitumen pipeline to Asian markets.
If everything goes smoothly, senior government officials say construction could start in 2029. But there's one important caveat.
If there's not a private sector component, there won't be a pipeline.
That's just one of the conditions as laid out in the agreement, as is Indigenous co-ownership and collaboration with BC to share the benefits. There has to be a new carbon pricing agreement, and the Pathways Carbon Capture project must move forward for the pipeline to do the same.
I don't know that the Prime Minister would have agreed to a new bitumen pipeline without Pathways, and we wouldn't have agreed to Pathways without a new bitumen pipeline.
The carbon storage program is key to Canada meeting its commitment of achieving net zero greenhouse gas emissions by 2050. The federal Conservatives are criticizing the process, saying the Prime Minister could push this ahead using existing legislation.
We even supported him, gives him the power to approve it. So we only need him to do one thing for this pipeline to happen. Get out of the way.
Now, Alberta has until July 1st to submit a pipeline project application to the new Major Projects Office. If all of the conditions are met, then the federal government will make an adjustment to the oil tanker ban on the coast of BC.
BC's Premier, David Eby, says talk of the new pipeline through the province is a needless distraction. And coastal First Nations are adamant it won't be built. CTV's Andrew Johnson filed this report.
Flanked by his flag-waving caucus, BC Premier David Eby responded today to the pipeline deal he was left out of for a project he calls fictional.
No proponent, no route, no money, no First Nation support. We need to make sure that this project doesn't become an energy vampire.
Eby labels the deal a drain on federal resources, a distraction from real projects, and missing critical consultation.
The first step, in my opinion, that has to happen is that the Prime Minister needs to sit down with coastal First Nations.
Coastal First Nations are clear in their opposition to a project they say could destroy their way of life.
We'll do everything in our power to protect our coast from a real threat of an oil spill. There is no technology that can clean up an oil spill. We will never consent to allowing oil tankers in our coastal waters.
The reaction from Northwest BC, the region also already at the center of multiple LNG and mining projects, is, according to one mayor, mixed.
People definitely want to see growth. We want to see economic activity. We want to see the communities flourish. The one thing about a pipe is, and this project right now that has me a bit concerned is I see BC taking all the risk and Alberta getting all the reward. So how do we line those up?
Public opinion in BC, according to a recent survey, is tilted towards supporting a new pipeline, but First Nations may have the final say. And as we've seen before in this province, if they are unwilling to sign on, a new pipeline may never materialize. Andrew Johnson, CTV News, Vancouver.
Up next, we are going to speak with one energy industry watcher. One question we'll explore, do we even really need a new pipeline right now? We'll be right back. The economy grew more than expected in the third quarter. GDP in Q3 was up 2.6% at an annual rate, fueled by growth in housing and government spending. However, imports posted a huge decline, dropping nearly 9%. StatSan says a fall in household spending also weighed on growth, and there was a slower accumulation in manufacturing inventories. Some analysts think the data won't encourage the Bank of Canada to cut rates at the next meeting. Alberta is lifting its 2025 gross domestic product forecast. The province now expects output to rise by 2.1% this year, while 2026 growth is expected to moderate further to 1.8%. The budget update from the province signals lower borrowing needs compared to the first quarter. The province's deficit is expected to be $6.4 billion for the 2025-26 fiscal year. Shares in Canadian gold producer Montage are trading higher. The company has agreed to acquire an Australian-listed company called African Gold. It's buying all the stock it doesn't already own. The deal is valued at $170 million US and adds a key project in Côte d'Ivoire to Montage's portfolio. Montage says the takeover will strengthen its footprint in the country. Once finalized, African Gold stockholders will own about 8% of the combined company. And you can see North American markets are up, the TSX pushing into new record territory. So Alberta and the federal government moving forward on energy cooperation. One of the big aspects of this is federal support for a new oil pipeline to the Pacific. Let's get more from Grace Wilton, Senior Energy Advisor at Enpro. Grace, thank you very much indeed for joining us. One thing I wanted to ask you, RBC research indicating that for now it looks like there is plenty of pipeline capacity for Alberta, but obviously the province has ambitious goals over the years to grow production.
Sorry, yeah, there is pipeline capacity. Are you talking about, in particular, Premier Eby's claims that there's enough capacity and that perhaps there isn't sufficient need for another pipeline?
That's one of the arguments he's been making. Yeah, could you look at that, please?
Yeah, sure. I mean, there is capacity for sure, but there's definitely a market for more bitumen in the Asian markets. Right now, that pipeline carries oil in its various forms, right? So it has to be mixed with other NGLs, natural gas liquids, in order to be able to be moved through that pipeline. My understanding is that there's definitely a market for more oil, in particular bitumen, in the Asian markets. And it has been a function of some of the regulatory burdens or obstacles that are there that make it less attractive, let's say. So the oil and emissions cap, for instance, that kind of puts a damper on production up until now to be able to produce enough to export more oil. Does that make sense?
Yes, and of course we are talking extended timelines here. It's going to be probably into the next decade before we did get a new pipeline, by the time they get the darn thing approved and built.
Yeah, so they're saying, word around the water cooler is 2029 earliest, which is pretty quickly, right? But what is part of this memorandum of understanding, and I'm not sure what you've already covered with your viewers, but it's basically a roadmap to fast track the pipeline. So once it basically has to be presented to the Major Projects Office by July 1st, 2026. It doesn't only include this pipeline, it obviously also includes the carbon capture and utilization and storage pathways project. So it's definitely a bilateral agreement that has been made that actually has further implications than just this pipeline. Because of all of the complementary regulatory lifting, there's also been Enbridge and TMX and another South Bow, I believe, have already wanted to be transporting more oil. So to the tune of something like, what have I got here? 1.4 million barrels of oil. That's a lot. Anyway, this whole memorandum of understanding yesterday has really put some wind in the sails of Alberta for sure. It is a win-win, I think.
Just on this new possible pipeline, it's expensive to build pipelines in BC. We learned that from the Trans Mountain expansion. That thing went, as you know, above 30 billion in costs. So will private industry be willing to take on that risk of massive cost overruns?
I think so. That pipeline that you mentioned, basically Canada bought that pipeline because of the clunky, for lack of a better term, regulatory procedure, right? So I think this whole process of having the Major Projects Office, I mean, it's not the ideal solution for a lot of people, but it's a solution. And it's a path forward to actually try to fast track things. I get that these projects up until now were already, inked and pretty well done, but not over the finish line. And we've had plenty of examples, case in point, that one pipeline that cost over $30 billion, where, it's so expensive and so burdensome that the federal government has to buy it in order for it to cross the finish line. In so doing, they learned a lot about what is appropriate and what's not appropriate, let's say, in terms of regulatory, in terms of regulations that have to be followed in order to complete. So, I mean, it's a win. Now, I think that the climate is there to welcome industry, to welcome a proponent, to invest in that pipeline if they see the case. Like right now, they've cut out the tanker ban so that if there's a bitumen pipeline, it gets to go to the port and get to market. They've suspended the clean electricity regulations in Alberta so that they can expand the grid, which these facilities require a lot of electricity, and they need the regulations lifted in order to be able to have the freedom to build. And that's what a proponent's looking for, is to be able to see that the government is not holding them down while they're trying to promote, business and growth, which we need in order to pay for the security that we've committed to, the security expansion that we've committed to. There's so many things that are associated with this. So long answer to your question. Yeah, I think there will be a proponent, but that's remaining to be seen. And if there is, there is. If there's not, there's not. But you know what? There's also a lot of lifted regulations that are just going to help industry, period. And I mean, to hear Danielle Smith be excited about the carbon capture, utilization, storage pathways project, I mean, it's good news all around.
Grace, thank you very much indeed for joining us.
Thank you so much, Andrew. Nice to see you again.
Thanks. Ditto. Grace Wilton, Senior Energy Advisor at Enpro. Coming up, Hot Picks. It's Black Friday. Of course, we're going to look at 3 ideas in retail. We'll be right back. Let's get to Hot Picks. And of course, it's a big shopping day. Our focus is retail. And we're joined by David Swartz, Senior Equity Analyst in Consumer Equity Research at Morningstar. David, great to see you. Do you pay a lot of attention to Black Friday? I mean, for an analyst in retail, does it provide important data, for example?
No, not really. It's really just one day out of the holiday period. And so you don't really want to draw conclusions as far as what the Black Friday sales look like. It's also hard to get good data. There's a lot of anecdotal discussion about shopping mall traffic and things like that, but you never really know if that translates into sales until later. And so people often will jump to conclusions perhaps prematurely.
Let's get to your first idea. Nike, they, of course, are big in China. They've had their troubles, though, in recent years, keeping up with the consumer. Actually, I didn't know that. The stock is down pretty sharply in the past year. You do see potential here, though?
Yeah, I do. Certainly, Nike stock has been down quite a lot. The company really has had 2 difficult years, and that's been reflected in the stock price. But, Nike still has a lot of strengths, including its connection to global sports. The company got a new CEO about a year ago, and he seems to be moving the company in the right direction. They're really focused on putting out quality products, performance products, and perhaps in the past, Nike had gotten away from that a little bit by focusing too much on the actual retail experience and moving away from their wholesale accounts. Nike right now is really trying to improve its relationships with wholesale partners, including the combined Dick's Sporting Goods and Foot Locker. And, I think in the long run, Nike still has the strongest position in this market, and still a favorable market. The sportswear market is very large and global. And, Nike right now, my fair value estimate is $104 a share. And so I think that for people that are willing to wait and see how this works out, I think this is potentially a good time to buy Nike.
Okay. Lululemon, a go-go stock. Maybe we'll put up a 5-year chart that did drop, something of a fallen angel. You see them getting their mojo back?
Yeah, like Nike, Lululemon's had kind of a difficult year, but you have to keep it in perspective that Lululemon's numbers are still really good for most apparel companies. The company generates very high margins. It does mostly direct selling, which is a model that really is very profitable for them. But people have been concerned that Lululemon's growth in North America has slowed. There's also concerns about the China sportswear market, which is a market where Lululemon expects to generate a lot of sales growth. But my fair value estimate on Lululemon is $295 a share. And so I think it's actually quite undervalued right now, which is quite a big change from the past when Lululemon was often very highly valued. And at one time, it traded at a PE of about 50 times. So Lululemon's valuation has certainly contracted considerably. And I think that this is a good opportunity to buy the stock at a good valuation. As a company that has no debt and generates huge amount of cash flow. And so very strong balance sheet as well.
Has the magic gone, though, for Lululemon? I mean, could it be that, sure, they were a cult stock, they did a great job of organizing local yoga groups, but has the gloss gone off the story? And
it is true that the market itself has become more competitive, and we have seen some strong competition in the women's athleisure space. But, you know, I still think that Lululemon has a lot of fans. I don't think that people have really soured on the brand. I think that recently Lululemon has not put out enough new stuff, and that people haven't had a good reason to shop there as that they have in the past. But Lululemon has a lot of new products coming out, and I think that consumers will respond. I still think that Lululemon has a strong following, and that the company really puts out very high quality products.
And then finally, Gildan, a very different story. Obviously, they do sell some stuff under their own brand, but they're a huge supplier of generic garments as well.
Yeah, so right now, Gildan is about to close its acquisition of Hanes Brands, the U.S. Major underwear and basic apparel manufacturer. And so, you know, that's really going to affect Gildan's consumer business. It's going to be a major consumer business now. In the past, and still today, Gildan is mainly known for printwear, which is producing essentially blank shirts for the printwear market. But Lululemon's also going to be a major company now in branded basics. And so, you know, I think this is a transformative acquisition for the company, and people don't necessarily recognize this. And the stock, both in the U.S. and Canada, are trading at very large discounts to my fair value estimates. My valuation in the Canada shares is $128 Canadian. So I think that there's really an opportunity right now to buy Gildan at a good valuation with this acquisition closing, which I think is really being undervalued by the stock market.
Leave us with a final thought. What retail generally, we know there's the relentless march online. What other big trends are you seeing, David?
Well, we are seeing some trends in terms of retailers that cater to lower income consumers, and higher income consumers are doing well, but the middle class is really not doing so well in the United States, especially. And so we're seeing a lot of weakness from department stores and from retailers that cater to the middle class, but we're seeing strength in retailers such as Ralph Lauren, for example, and also Urban Outfitters labels in the U.S. That cater to higher income consumers, but also lower income consumers and middle class consumers are shopping at clearance stores like Ross and TJ Maxx in the U.S. And so we are seeing some changes, and these have really been ongoing for years, but they have continued this year and probably will continue into the future, where retailers that cater to the middle class are continuing to struggle.
We'd better leave it there. Thank you very much, David.
Thanks.
David Swartz, Senior Equity Analyst in Consumer Equity Research at Morningstar. Up next, we are going to talk to Michael Davenport of Oxford Economics about that strong quarter on the surface for Canada's GDP, but does it hide underlying weakness? We'll be right back. So on the surface, the Canadian economy showed surprising strength in the third quarter, with GDP up at a 2.6% annualized rate. But let's get more on this from Michael Davenport, Senior Economist at Oxford Economics. Thank you very much for joining us. Seeing quite a bit of commentary today that this number looks good, but it's masking underlying weakness in our economy.
Good morning. Thanks for having me. Yeah, so the headline GDP print was certainly stronger than expected. It was stronger than our expectations. It was stronger than the consensus of economists and the consensus in the market, and also stronger than the Bank of Canada's forecast, the Bank of Canada's estimate for the third quarter. However, what we saw was actually that headline strong GDP print of 0.6% quarter on quarter was flattered and boosted by a large decline in imports. Mm-hmm. So imports fell 2.2% quarter on quarter. That was the largest contraction in imports of goods and services since the fourth quarter of 2022. And so actually, if we look at the spending of households, businesses, and governments in the economy, so what we call final domestic demand, that was actually flat quarter on quarter in the third quarter. So a much weaker picture for the Canadian economy once you look past the big decline in imports and sort of focus on the spending of businesses, households, and governments domestically.
And yeah, I mean, government spent heavily. A lot of that tied to the defense build out, but there certainly wasn't strength in business investment, that perennial problem.
Absolutely not. So business investment fell, whether it be non-residential structures, so non-residential construction, machinery and equipment also declined, and investment in intellectual property products fell. So all of the three major categories of private sector business investment declined. That follows declines for machinery and equipment investment in particular in the second quarter. And we think that continues to reflect not only significant U.S. tariffs that are causing firms to pull back on their major capital expenditure plans, but also this environment of uncertainty created by trade policy uncertainty. Businesses not having certainty about access to the U.S. market, we think that's a key factor that's continuing to cause them to pull back on their investment, to put off major new capital expenditure plans. And we think that's something that's likely going to continue until a trade deal with the U.S. Is finalized.
And can you just remind me, when you get imports down, does that boost your GDP number?
Exactly, yes. So imports are subtracted from GDP. You can think about it as when a Canadian buys, whether it be a household or a firm or government, buys goods or services from outside of the economy, that is an import. And so that money is leaving the economy, and that gets subtracted from the aggregate amount of goods and services produced, or in the case of GDP on an expenditure basis that we're talking about today, the total amount of goods and services purchased, or the total amount of spending in the economy.
I mean, GDP, well, it's hard. I mean, you got an economy of 40 million people. It's hard to measure. It's a complex entity you're trying to track. But GDP is a flawed measure in many ways.
Some people would say so. It definitely does not capture all aspects of, say, economic activity, all aspects of the economy. We look at a wide range of indicators when we try to gauge what's actually going on the ground in the economy and what's likely to happen going forward. If you look at other indicators, for example, indicators of the labor market, paints a much weaker picture, I would say, in the third quarter in particular. Now, the labor force survey, we've seen some pretty strong job growth numbers, headline job growth numbers in October and September. However, the survey of payrolls, which is a less timely but often more reliable measure of total employment in the Canadian economy, has been much weaker, shown job losses for several months, and another large decline in September. That data was just released earlier this week. So yes, GDP is not an all-encompassing, measure or a final overall statement on how well the economy is doing. In this case, again, those headlines, that strong headline GDP figure was boosted by imports. It doesn't necessarily mean that the Canadian economy is booming, and we don't expect growth to continue at this pace going forward.
I know productivity gets discussed ad nauseum, but is there any actual potential for the value added by Canadian workers to increase significantly in years to come? Because governments have just failed to achieve on that metric.
We're somewhat optimistic on the productivity outlook, looking out, let's say, the next 5 to 10 years. Canadian productivity has been incredibly weak over the last 5 to 10 years, as you point out. However, we do expect there will be somewhat of a recovery in the next over the next little while. That in part reflects technological developments, so things such as the positive impacts of artificial intelligence, which should over time lead to productivity improvements. And also, we're starting to see the pendulum swing a little bit on the government side towards more of a growth forward agenda, whether that be through support for major natural resource projects. We just saw the big announcement yesterday, the memorandum of understanding between the Calgary provincial government, the Alberta provincial governments and the federal government, that they do want to get a pipeline built. We've seen other announcements of major nation-building projects focused in the natural resource sector in particular. Those, over time, if realized, should help to improve aggregate productivity in the Canadian economy. And we do think that that will occur over time. We've also seen the government start to bring forward more measures targeted at improving productivity and getting more business investment, sort of remedying the long-standing lackluster business investment issue that has really plagued the Canadian economy for several years.
Well, we see the support for resource projects, but the population, as you know, is in central Canada, and we don't seem to see the same emphasis on high-tech manufacturing, for example.
Yeah, absolutely. I mean, I think what we're seeing with the resource projects, these are in many respects the somewhat low-hanging fruit. The projects that the government has identified as areas that they can quickly get money moving, get shovels in the ground, and get more Canadian products to market. And that should help to improve productivity as well as broader economic growth. Now, you're absolutely right. We can't just see growth in the natural resource sector. What we need to see is more productive high-tech manufacturing investment as well. And we're hopeful that that will come over time.
Thank you very much, Michael. Really appreciate it.
My pleasure. Thank you for having me.
Michael Davenport, senior economist at Oxford Economics. Let's have a quick look at the markets and the silver stocks. They are shining today. TSX pushing into new record territory. And there are some of the big movers. Spot silver hitting a new record high today, north of $54 US an ounce. It has doubled pretty well this year, almost doubled. And you can see if you have silver or precious metals in your name, investors are likely to be taking a closer look at you. Let's have a look at some stocks that are seeing some selling today. We did see investors moving out of Constellation Software. That stock has had a rough year, partly because of a malaise affecting just about all traditional software stocks. Worries that the advent of AI will upend their business. Why do you need to hire expensive programmers if AI can do so much for you? Constellation is up a little bit from November 11th, when it was about 3,155. So it has bounced a little bit, but that stock down 24% this year. Gildan Activewear, David Swartz says he likes the look of it, but it is down a little bit today. And Exchange Income Corporation also losing some altitude. Could we have a quick look at the TSX Banks Index? Because that's been hitting record highs this week, fueled by names such as National Bank of Canada and Royal Bank of Canada. And sure enough, it is trading in record territory. Sometimes I think you should just buy the Canadian bank stocks and nothing else. In any case, history doesn't always provide an accurate guide to the future. Thanks very much for watching The Open. Morning Markets is up next.